I now recognize the gentleman from Missouri, Mr. Luetkemeyer, who is also the chairman of the Subcommittee on National Security.
Thank you, Mr. Chairman. Mr. Theodoro, I want to focus for a second on some of the self-inflicted problems in certain state insurance markets like California, which you mentioned. That seemed to have a regulatory bias against insurers transferring risk from their balance sheets to the global reinsurance marketplace. From what I've seen, the ESG regulatory activism in California might be the worst of all. Right now, California is the only state in the country that does not allow insurers' rates to be based on their actual reinsurance costs. So as reinsurance costs go up, insurers cannot have their rates reflect those higher costs. As a result, more reinsurers are starting to treat wildfires as a primary risk and not a secondary peril. The cost of reinsurance has shot up while the cost of primary insurance companies of underwriting wildfire risk has stayed more or less flat. The natural result here is either insurers have to purchase less reinsurance or they will pull back from issuing new homeowners coverage in the state, as 3 of California's top insurers have done in this last year. So Californians get fewer options and higher prices while the willing risk capacity of the $630 billion global reinsurance market goes underutilized. Mr. Theodoro, does it make any sense to you that California would deliberately discourage the use of reinsurance at a time when its primary insurers are actively fleeing its homeowners market? How would the great use of global reinsurance reinsurance and risk sharing help to benefit California consumers?
Yes, thank you, Congressman Luetkemeyer, for that question. Indeed, in California, where the cost of reinsurance is not permitted to be included in insurance rate making, you have a catch-22. The reinsurance rates are going up because the risk is going up, and the insurers have their hands tied, and they can't get more than a 6.9% increase. If it goes into the intervenor process, it may be extended beyond the 60 days. So it's unfortunate that California can't use reinsurance to its benefit. And then to the question earlier, too, about reinsurance capacity is there. The citizens in Florida got $1 billion of reinsurance from Warren Buffett's Berkshire Hathaway, and TWIA, the Texas Wind Insurance Authority, secured over $1 billion of reinsurance protection from the private reinsurance industry and also from the cat bond industry. So reinsurers do have the capital, and they're willing to deploy it if they can make a fair margin. So, and there are people that are standing on the sidelines, as Berkshire Hathaway was last year, when they didn't participate in the Citizens Program because the rates were inadequate.
It would seem to me that if you were incentivized to use the reinsurance market more, it would actually drive down your costs. I know when I was chairman of this committee 6.5 years ago, we were working on flood insurance, and we wanted to use the reinsurance market to help that situation. And if we would have done it over the previous 20 years, we actually would have paid all of our claims, never had anything, any tax bills go to the taxpayers, and still would have had coverage at a minimum rate increase. So there's a place for it. What is the percentage of increase in insurance costs due to ESG regulations? Mr. Theodore, you know offhand?
I don't have a number for this. The main ESG legislation is directed at state public pension funds.
Okay. Ms. Hewitt, one of the questions that I've got is with regards to the increasing costs of financing homes and how many people are unable to finance a home as costs go up. Rules and regulations, can you give me an idea of what the cost of rules and regulations are from the standpoint of your average cost of home? What would be the average cost of rules and regulations to a taxpayer or to the homeowner?
Yes, sir. Thank you very much for that question. The latest study that NAHB has conducted that was published in May of 2021 showed that regulations imposed by all levels of government accounted for $93,870 of the average price of a single-family new home, which that average price was around $397,000. and that's about 23.8, almost 24% of the price of a new home. Our studies also show that for every $1,000 increase, 149,000 people are priced out of the market.
Okay, so for every $1,000 increase in the cost of financing a home, 149,000 people are unable to get themselves into a home. Is that what you just said?
Yes, sir.
Thank you very much.
The gentleman's time is expired.